Thinking a stock is undervalued when it is 30 to 40 PE automatically disqualify you from being a finance YouTuber. So that's the hard work that I think it will pay off rather than, I look at the PE. Other investors don't even look at the PE. So I am smart.
So today we have a really special episode. I think we wanted to show some spotlight for a fellow viewer of our channel. I think his name is called Mar. Actually, I don't have much comments on this particular post, right? I'll let the stage over to the three of them because the three of them had a very intense discussion about him. I will just furnish out some of his comments here and then maybe just read them out. His comment is targeted onto Kelvin. So he said that, and I quote, "Kelvin is a hopeless bull, lol. Don't think he knows how to read a basic chart. He's going to lead so many people who are part of the herd to a multi-year bear window, lol. Buying at all-time highs and being so smart. Don't know what qualifies him to teach people how to invest," unquote. Then after that, there was a very extended discussion between, I think, Bunty, Kelvin, and Mala himself. So I'll just state the facts here that me and Eric has chosen not to participate, but maybe I'll just open the floor to Kelvin and Bunty.
I think this one mainly is pointing towards Kelvin, right? Because we produce content all the time and then we get comments all the time. Some are good, some are bad, but sometimes they are targeted, right? You say, "Oh, Kelvin, you are hopeless." So I don't know. I'm just curious to hear Kelvin's thoughts on your immediate response when it comes to this kind of comment. Like people tell you you're hopeless, you are leading people doing all the stupid things. Essentially, it's an attack, right, Kelvin? Do you see that as an attack that you need to counter back?
No lah, don't need to counter back. The facts speak for itself, right? Hopeless bull, I think I am. I'm starting to deny. Okay, if you just look, maybe the S&P, I've just used that as an example. You can't say that based on past 100 years, you don't believe the S&P will continue going up because I look at history. There are past 100 years, there's a 76% chance S&P will end the year in green. So if you just throw a dice, there's a 76% chance that you make money that year, assuming you invest in the S&P. Then about the bear part, right? If you just look historically, the bear market has always been a lot shorter, and what comes after that is a very long bull market, at least I think 2 or 3 times bigger than the previous bear market. So basically this thing is trying to time the bear market, which is the 24% chance that will happen. He's just deducing this, that the market crash will come based on a basic chart. In that case, I'm assuming that he's referring to the peak in the market, peak in the S&P 500 lah. But then you have to look at all the economic data and stuff, right? So I can just name a few to just show that I believe otherwise lah. First, analysts believe that the company earnings will go up next year. Then the second one is the unemployment rate is still low, 4% now lah. Okay, but by the time the Fed lowers rate, maybe it will reach 5%. But never mind, the Fed will lower the interest rate to a bit lah. Maybe this year, maybe once or twice. So that will cool down the inflation and the unemployment rate. Both will go back down lah. So what will cause this bear market to happen? Okay, so basically it will be a recession. But then if you look at those recession based on history lah, whenever recession happens, right, 1 year after recession, the market ends up higher as compared to when the recession happens. So again, are you trying to time the recession, which historically show that you can't time the recession? Okay, so then the only thing that can make this crash is what's that called? Black swan event, which probably is a war. But then this Ukraine war is happening for so long, and we have seen the market go up by, I don't know, few 10, 20%, 30, or even higher than that, right? So unless you're telling me you can time this black swan event, which is probably another pandemic or World War III or another alien invasion, I don't know. You're not based on past data, which has everything points to you being incorrect. So I don't know. I don't know how to continue this.
I'm trying to argue from the other way around, right? Because if you study the history, for example, the previous bubble, right? Let's call it the period right before the global financial crisis, which is, let's say, around 2006, 2007, when the market is good, right? Actually, if you just look at the data at that point, there's no clear sign that we are all heading for a big crash also. Inherently, we don't know when all this crash will happen. Okay, so nobody can time it. That's first fact first, right? And then the secondly is, if you look at the valuation, I think it is quite hard to deny that, especially in US market, the valuations are still quite high. And this one happened just 2 years back. If you look at the metrics, 2021 was quite high, and then we have corrections, right? Then now it's going back to all-time high again. And if you look at the metrics, it's similar valuations appear again, and then market getting frothy, people are shouting to buy AI stocks and so on. So let's say if really, I mean, just project 1 year forward, really we have a, let's call it like 20 to 30% crash, right? Then all these people will come in, jump in again. See, you perma bull, you keep on leading people to go and lose money in the stock market. Will you like do some self-assessment to say that, okay, now I admit, right, I could be wrong, or be more humble about it?
I think this, you have to look at, like, when you say nobody can time the market, it really means nobody. Like, even like, okay, we look at Peter Lynch, Benjamin Graham, even Warren Buffett, right? He has timed the market. All of them they can't even time the market, basically, and all of them make mistakes. And if you think that you can time the market this time, can you continue timing the market next 5 years, 10 years, 20 years, 30 years? You are going to get one of them wrong. And if you just get one of them wrong, your profit is going to be cut by half. This again is based on history. I'm always doing everything based on historical data. So I think if you just miss the best 20, 30 days of the best days in a 20-year period, so it's like 30 days out of a 20-year period, your returns will start to be negative already. You might as well don't invest, just buy fixed deposit and be done with it. And all these best days in the market always happens right after a very bad day, within 2 weeks, within 2 weeks time. So we have seen this guy who commented, he replied, right? After his first comment, his second comment, he said, "Oh, Kevin, see, are you so quiet now?" That he commented that during the market crash. Then right after that, the next day, the market returned back to normal again. It went green. So, and we replied to him, right? And he gone missing again. So we are just waiting for the next market crash, maybe another 5% drop before he reappears. So why not just sell now and buy back later, right? I think the thing to remember is that market only does well when companies are doing well. So companies don't go up for no reason. And if you just look at all these earnings per share, right, it's sort of trending in line with the market growth. So unless you are saying the valuation is going way higher, maybe that, right, way higher than the stock price, then obviously then there will be a concern, right? Then the other thing you can look at is the S&P 500 PE ratio is now way higher than the historical average. But then you could also say that historically, the productivity of the companies have been lower. So could it be that this average PE ratio is now trending upwards rather than a straight line? Because companies are earning more money now, so they have the capability to grow faster. In that case, does this PE ratio does it justify going upwards rather than a straight line? So this kind of things, this is what I'm basing on. Yeah, curious to hear Chicken and Eric's thoughts.
So I was just looking with interest at how Wunti and Kelvin engage this person. Because I think this person sort of is a little bit, should I say, 有一点 childish. I hope you are DCAing, then obviously it's with a bit of sarcasm, right? This market is going to crash, and then if you have this kind of thinking that it disqualifies you from being a YouTuber, and hopefully you are buying in aggressively now so that the market crash, you will get it. That kind of thing it reminds me of a small kid nanny boo boo, those kind of thing. So when I look at it, I was like, wow, it's quite childish I don't know. So, and the last comment he was saying, right, you cannot time the market. And then after that, he said that Warren Buffett won't even be selling his Apple shares. Then he can see things that we cannot. I think that's the thing with reading too much into what the famous investors are doing. Warren Buffett, they hold so much shares, right? Their buy and sell will affect the market itself. So for him, he cannot really so-called time the market, even if he got crystal ball, which I don't think he does. Even if he has, right, very hard for him to sell right at the top, because the fact of by him selling, right, that itself, the volume will move the market already. So it will cause the stock price to come down. And I think that Joseph Carlson, this YouTuber, he actually did a video recently that says that the percentage of Berkshire, right, their cash holdings, the percentage relative to its long-term average, right, is around there one. So what Warren Buffett is doing maybe is just to maintain the equity versus cash portion. So he needs to look at the whole portfolio and size it accordingly. So it's not like for us retail investors, we have very different timeline, very different amounts. What we do cannot move the market at all. what he does will move the market. Even rumors of what he does move the market. So I think it's a bit not very wise to take what he does and read too much into it. Like, oh, he's selling half his Apple. So, confirm market going to crash. I don't know. Market one day is definitely going to crash. Then people are going to attribute it to him selling half of Apple. But if he does know it's going to crash, right? Let's say he does know with high certainty, right? I would think that he will sell all. Why sell 50%? Why still hold on to 50%? Like, I think there's a case to be had. And in fact, he's a long-term buyer. He could just buy puts. If he knows with high certainty, near term, there's going to be a crash. You can buy puts also. Puts is very cheap for Apple. So I don't know, like the logic is a bit, it eludes me. Yeah, so that's my
Eric, quite funny. You reject his logic and then you still play in his logic.
Yeah, I have to play with his logic to see what is he thinking about.
But like you said, right, if you reject the idea that because of the premise of the discussion that because Buffett is selling, that's why he's bearish or he's not hopeful, then later, two quarters later, Buffett tell you he sell another 50%. So means that does it mean that he's really bearish? Or does it mean that he's up seeing a coming crash?
I mean, I'm saying that as a hypothetical question, right? Like, if he does know, he would sell everything one shot. Why 50, then 50, then what is he trying to do? Yeah, so I think nobody knows for certain how the market is going to perform. Everything that we do is just to maximize the probability of not losing money, of making more money. So I don't know, like for us, I don't think we can read too much into their movement. If not, the copy super investor, everybody will be rich already. We just copy the George Soros, Warren Buffett, what already. No need to think for ourselves. Because it's not as straightforward as what we think.
About the issue of the Buffett selling his stock, right? He might be just reacting to he is this commenter. He might be just reacting to the news that, oh, Buffett is selling his Apple shares. But the thing is, Buffett has been selling his Apple shares all the way back since I think 3-4 months ago. And the reason for selling his share is not because of whatever economic data that he saw. But Buffett himself he already says that he doesn't care what the Fed is doing, right? And if you just look at the Berkshire Hathaway portfolio, Apple is like 40% of his portfolio. Just because he has run out, he's just trying to become a good investor by reducing his allocation. When this news came out, Buffett has already sold half of his Apple holding. So, he isn't dumping all in on that day. Like, he's not like Nancy Pelosi, like, I'm going to buy Nvidia course on this day. So it's totally not like that. So I think the one advice, this is a classical case of a new investor. Maybe I'm still like that. I think the earlier you realize you can't time the market, that no one can time the market, the better investor you'll be later on. And trying to time this peak means that you be exposed yourself to this market timing risk, which if it continues going up, you're going to be F up. But it's okay to make this mistake early on. But if you make this mistake 5 years down when your portfolio is so big, you'll be missing out like a few 100K kind of returns. So
let me comment on the subsequent part of the post. So, there's these back and forth conversations, right? The one that actually triggered me is not the one that he's attacking Kelvin. Kelvin got attacked all the times when we're having fun reading those attacks. So I don't have much opinion on that. But the part that I have a lot of opinion on is the part that he says that, thinking a stock is undervalued when it is 30 to 40 PE automatically disqualify you from being a finance YouTuber. First thing is that we don't know, at least I don't know which stock that he's referring to, like 30 or 40 XPE. But I think in the earlier discussion, we are talking about like US stock market. We are commenting that this is like quite expensive, right? But if I just look at the PE chart of S&P 500, right? Maybe let me just do a screen sharing. I'm pulling from the Yadeni website. So it's showing the forward PE for S&P 500. So you see all these different lines, right? These are actually the earning per share and then multiply by different PE. Say, for example, if it is priced at 10x PE, the price should be at this level, the level. Right now, if you just look at this chart, we are about like 20x PE for this entire S&P 500. You want to say this 20x PE, is it like very high or not? Of course, it's like higher compared to like average or compared to median or compared to history. It's on the high side, but it's not the highest it has been, right? So I think like when we're commenting like 30 or 40x PE and just judging that the market is expensive just because of that, I think it's also a bit childish lah. That's the comment I have. And also I responded to the guy, right? I said that if you just look at the PE alone and your notions of whether it's expensive or it's cheap, everything is just based on PE, I think you are missing a big point because the PE is not a static thing, right? It is a price divided by the earnings, and earnings are growing, right? And they are fluctuating. Some companies, even PE is very low, but you can see that the earnings is coming down, right? Then should you just thinking that the stock is cheap because the PE is, let's say 5, knowing that the earnings will drop by 80% in the next 2 years? It's no, right? So that's why I think we need to like have a more holistic view on the market, on any particular stocks to judge whether it's expensive or not.
You all keep saying he's childish. Maybe I'll try to defend him a little bit because I'm the youngest one here. Okay, a few things first, right? Before I talk about the comments specifically, just to support or to credit what Kelvin was talking about. Let me share a screen also. So just now when Kelvin was talking about earnings returns, right? Like what is basically driving the returns of the stock market. I think this chart done by JPM was quite good. Basically, they reflected what's the contributions to the returns of the S&P 500, broken down into 3 specific categories here. One is multiple expansion, earnings expansion, and dividend returns. I do understand where this Mala guy is coming from, because if you have to really take a closer look, if you exclude the 2022 bear market, right, that came in here, I think when you look past the last 5 years in a way, you can see that this grey bar is exceptionally big. And this grey bar is denoted by multiples expansion. This research is a bit dated because it's accurate as of March 31st. But even in 2024 alone, you can see that on a year-to-date basis, the earnings part was only largely driven in 2020, which was the low base effect because of the COVID recovery. But other than that, I think over the last 5 years, you can see this grey bar, which is multiples expansion, it has basically made up a large part of what the returns were. And I think considering what Bunti showed just now as well, the chart that Bunti showed about the 18, 20 times of the S&P, I think moving forward, a lot of people are also attuned to the fact that, hey, 18 times, 20 times, it's normal. This is the new norm moving forward because of the high quality nature of the US stock market, because all your Angmo companies are the best in the world. That's why all the capital congregate to those batch of companies. But if you really take a very, very long-term horizon over the last 40, 50 years, I think the norm is probably closer to 15 to 16 times. Because let's not forget the S&P 500 is a basket of 500 companies that are not all quality companies. I think it's arguable that if you look at the equal weighted index, there are quite a lot of low quality companies there in the S&P 500 as well that is kind of dragging down the returns. So I don't know. You don't ask me, don't pose me back the question on what is the actual number or what's the correct number. I don't think there's a correct number, but I can understand why there is a group of investors that think that we are in slightly elevated levels. And moving forward, a lot of people benchmark or they peg themselves saying that 20 times is good or is normal. But if you pull a longer time horizon, actually 15 times is more normal, regardless of what normal means. But back to the point, I think what Kelvin said is still true, because earnings in the long term still drive most returns. Multiple expansion is not sustainable because unless you subscribe to the mentality that you can just keep printing money, keep driving valuations up, and then everything is fine and dandy. So yeah, that's on the valuations part.
I think there's no doubt that the valuations is elevated. But with the questions that we need to ask ourselves is that what kind of game that we are playing, right? Are you playing the long-term game or are you playing the short-term game? Because if you are playing the short-term game, you want to know when the valuation change. Because doesn't matter you buy it at 20, as long as it went from 20 to 25, you still earn money. I mean, I'm focusing on the short term. If I play the momentum game, right, I can buy at 30, sell at 40, still making money, right? So that's the short term game, and you want to avoid the multiple contractions. Even if it's 10 PE, I short sell it, and then it dropped to 8, I still make money. That's the game that traders are playing. But if you want to play the long term game, right, what you want to focus on is actually the green bar that you are showing on your charts, right? The part that shows that on average over a long period of time, actually the green bar is like on average they give you earnings of like 6% each based on the number you show. I switch the game between like long game and short game, and just jumping around and thinking that, I want to invest for the long term, but I want to play the short term, and you're using the wrong metrics to play the game. That's the dangerous things that many people are playing now.
I completely agree, by the way, but I'm more curious about when Mala left this comment, right? I presume that he's quite anti-US now, because probably from a valuation perspective. And he did take a jab at Kelvin, saying that hope you continue our bull thesis as the market pulls back and don't change your strategy to REITs or China in a year or two. I can get where it's coming from, but I have a question for him if he actually is watching this video, is that when was the last time that you added to your US positions? Like back then when 2020 crash came, 2022 crash came, I wonder, number one, did he add? And number two, considering this run up, did he sell? So if he is, then if you judge from this particular action, then yeah, he's technically trading the valuation of the general market. I'm not too sure whether he stock picks, but that was the game that he's playing. But I think back to the question again about this whole valuation idea on whether you're buying on the high or on the low, right? If you do subscribe to the idea of reversion to the mean and what is that economies and stock market moves in cycles, then you can kind of maybe appreciate a little bit more on why he wants to talk about buying on the lower side. And I don't know whether he will let go on the higher side, but buy on the lower side and hold for the long term. I think that's generally the main idea that he's talking about lah. But anyway, that's to talk to Kelvin. Back to this whole post, right? I just feel that it's two different, one chicken and one duck talking to each other. You get what I mean? They're just subscribed to completely different ideologies, and they're trying to start a war where you have people, the chicken in the chicken camp and the ducks in the ducks camp, and then they want to instigate some sort of discussion where there's no point, because Kelvin is clearly in the buy and hold, DCA, don't care the market go where, drop, you buy more, that kind of camp. And you can tell him however expensive it is, the stock market is in the short term, he will pull out the 100-year chart and tell you it's not expensive because it keeps going up. You get what I mean? So there is no point in engaging in this discussion. That's my personal perspective. So that's why when you guys were talking about this whole comments, right, then you all sent a group, I clearly didn't engage and I didn't bother. But since it's a comment, then we want to talk about it. I think the second part of the discussion is more important, because the first part is just a clash in ideology. The second part about this PE, expensive PE, that's why you don't buy the stock. I think this is quite dangerous. This idea of, because it's 30 times or 40 times PE is dangerous. And like Bonti has put out his whole idea that he said that he bought Nvidia when the stock was at 65 times PE, and this was in May of 2020. And I think Nvidia has probably more than 10x from then again. And purely because when you look at Nvidia's earnings, it basically grew in triple-digit clips for like, I don't know how many quarters. So that's why earnings in this case is not validated. And that's why I think this conversation is more thoughtful or more useful in a way, rather than the discussing about what. Because like you said, different ideology, different game that they're playing. So yeah, Bonti, maybe you want to share more.
Yeah, I'll clarify on that post. We are having like this kind of like tension kind of discussions, right? The intention is not really to say that, you see, I'm smart, you're noob, so I make returns, you don't make returns. It's not like that. It's more just to point to people that if you have like a strict guideline to say that your PE above 40, I don't touch, it's expensive. Maybe it's not just as simple as you are missing the good company. That could be, the surface understanding to look at things. The other things that is more important, which I want to point out, is that you cannot just think that like doing individual stock analysis, then your method is like, I look at PE, I look at PB, I call it like, oh, this is my stock analysis. This is all done, right? I've done a good job. You see, so detailed. I can pull out all the like big tables. I think it's not just that. There are many angles that is not covered under all these metrics. Like how do we know that this company can grow their earnings in such a huge, like percentage over short number of years, right? This one, you cannot just look at the historical financial and do extrapolations. It's not as simple as that. If you look at the earnings, right, it's not like they have been growing at earnings of, let's say, 50% for many years before that. It's not like that. It's really there are period that they are going down, and then just before it blows up, right, we managed to call it, and we managed to call it because you study the company, you know the product, you know what they're working on, and you know that the stuff that they're working on, right, has generated, for example, like let's say $0 billion of revenue. It's not even there yet, and you already foresee that because you know the business, you know they are working on all this like advanced stuff. that other people are not even trying to compete with, right? That's why if you look at companies, I mean, we take NVIDIA as a case study here because, I mean, this is the hype stocks as of today, right? But you can see that they have been working on all this infrastructure, all this tech for like almost 10 years. So if you do a comprehensive analysis, I will argue that these are the things that you should monitor and not just like the PE. The PE is just like everyone can look at it. You just go Yahoo Finance, things that everyone can see, right? There's no value there, you know. So it's all have been like people have known about it. If you want to do individual stock analysis, you really need to go to the places that other people won't go. Study things that are hard, like why NVIDIA is better than AMD, like why AMD is like finding a hard time just to compete. And you need to, like beef up your knowledge to in order to process all this, right? So that's the hard work that I think it will pay off rather than, I look at the PE. Other investors don't even look at the PE. So I am smart, So I think that one doesn't work at today's environment where all these informations are available to everyone. So it becomes useless already, the PE. That's my feel. Yeah.
I think to add on, the PE is a bit backward looking. It doesn't take into account the future growth. So like NVIDIA, the PE, let's say the PE is 50 now. Then, then the company releases earnings. Then all of a sudden the PE drop because the earnings increase. Is the stock suddenly cheaper now? Or whatever PE metric they use didn't take into account this growth. So if you want a deeper analysis of the company, you should use DCF, the discounted cash flow, which takes into account the growth lah. It's at least better than PE, but it's not perfect. I think like Bunti said, you have to just beef up your investment knowledge rather than think that you are right all the time, in which case you wouldn't be improving, right?
And also, aside from like knowing all this, the things that many people lack is the patience lah. Like I purposely mentioned this because the positions was like first initiated in 2020. It has been like 4 years, right? Just holding. Many of my portfolio also is the same, just holding. Like hold until you forget that you actually hold the stocks, right? And I also posted on my X account on like you look at the TSMC revenue, right? 2020 when I bought, right? Let's say their June 2020 revenue was 120. I think this is 120 billion NTD, Taiwanese dollar. Now from 120, it's already increased to 250. It's already like double. And this one is like, yes, revenue can double, but it doesn't double unless you are NVIDIA. Right? It don't double like within 3 months. Right? It takes years to double and take years again, like 5 years, 7 years, 10 years to double again. So you really need to hold long enough and not just like, I think PE high, I sell, then PE low, I think I buy, then what's the difference between this kind of operation versus a trader, right? And we call ourselves investor yet and going in and out.
I think the bigger worry, Mala is probably sold on the idea that the US market will have its coming lost decade because it's not something new. I think a lot of people are also accustomed to the idea that US stock market just keep going up, right? But if you study the last 20, 30, 40 years, there are periods where the market didn't go anywhere. And it's, I guess, if you take his word or you take his comments at the essence, he did say that leading the herd to a multi-year bear window, lol. I mean, in his first comment. So I guess he is quite sold on the idea that the US market is not going to go anywhere. And it's going to be very overvalued. And there are times where we are in such windows. But I presume that if you are in the security selection space, then I think however the index is performing doesn't really matter to you. That's just my perspective lah, because if you look at how the professionals are doing it. But I think long story short, despite that, if back to the question on what game you are playing, if you are playing a 100-year game like Kelvin, then this 5-10-year period probably shouldn't matter. I think that's just a quick ending thought from me.
This last decade, again, it has happened in the past, right? But it doesn't really matter because as long as you don't sell, you don't lose money. I think that is a very important thing to remember. You don't sell, you don't lose money. They say, oh yeah, but I have unrealized loss. But you don't need that money now. Why are you so concerned about the unrealized loss, which you can't control? It's like saying okay, today Singapore is raining. What can you do? Oh, I don't leave the house. You don't leave the house, you're not going to go to work, right? You're not going to meet your girlfriend. You're not going to your hotel 81 or whatever. But you need to go out because you got the urge, whatever. So you take an umbrella and you go out. You go out like a man that you are supposed to be. So it's the same for investing. You The earlier you realize you can't control the rain, or in this case, the market crash, the better investor you will be 20, 30 years from now. So you have to anticipate that there will be a lost decade, the S&P you'll give a lower return. So what can you do in that case? You start your investing with all these investment plans like, okay, I will DCA, I will keep some cash on the sidelines. That cash must be parked in the money market fund that gives like maybe 3% return while I'm waiting. And if it crash, I will start to buy at support levels. I will buy those companies at intrinsic levels, below intrinsic levels. Or maybe if I want, I can start selling options on selling puts to earn additional income. All of this, there are a lot of things that you can do, and not just, I stop buying, I sell at the peak and hope that the market drops in the near future, because all the data points that the market won't drop in the near future, barring any black swan events, of course. They say, this kind of thing. Yeah, market will eventually drop. You will eventually be right, and I will have haters coming. You tell me to buy. It will eventually happen, but when is it going to happen? No one knows. And the earlier you realize you are not Warren Buffett or the god, the better off you'll be lah.
Okay, that marks a very good conclusion to this entire discussion, and we'll see you guys in the comments below. With that, we'll see you in the next video. Goodbye.